So the credibility of money is underpinned by this two-tier monetary structure, where commercial banks create money and central banks preserve its value. Three new developments have emerged in the past decade that fundamentally challenge this two-tier monetary structure: cryptocurrencies, stablecoins, and central bank digital currencies. Let's start with cryptocurrencies. A cryptocurrency is a digital token issued and managed by a decentralized protocol or within a decentralized protocol, such as a distributed ledger or blockchain. It represents an asset in digital form that can be transferred or traded on the protocol. The word crypto comes from the Greek word kryptos, which means secret. Indeed, the anonymity of crypto tokens has unfortunately made them well-suited for facilitating illicit transactions, including money laundering. Cryptocurrencies have also helped to fuel ransomware, one of the fastest-growing crimes in cyberspace. Are cryptocurrencies money? So far, the answer must be no. Cryptocurrencies have performed poorly as a medium of exchange, a store of value, or a unit of account. MAS prefers to call them by their more accurate technical name, crypto tokens. And we define tokens that are used for payments as digital payment tokens. And entities which provide services related to such tokens in Singapore are subject to licensing and supervision by MAS, primarily for money laundering and terrorism financing risks. MAS frowns on cryptocurrencies or tokens as an investment asset for retail investors. The prices of crypto tokens are not anchored on any economic fundamentals and are subject to sharp speculative swings. Investors in these tokens are at risk of suffering significant losses. But MAS is also of the view that blockchains and crypto tokens can bring many potential benefits. The blockchain is suited for applications where it is important to know the history of ownership and transfer of value, but there is no trusted central party or reliance on a central party is too costly. A potentially strong use case of crypto tokens is to facilitate cheaper and faster cross-border payments and trade finance. But to be regarded as money, crypto tokens need to be more stable in value and have credible backing. Hence the emergence of the second phenomenon, stablecoins. Stablecoins seek to combine the credibility of fiat currencies with the advantages of the blockchain. The more prevalent stablecoins are pegged to the US dollar. They promise to redeem at par and claim to be backed by reserves. Will Juno accept stablecoins as money? Well, an encouraging sign is that stablecoins are beginning to find acceptance outside of the crypto ecosystem. Some technology firms have integrated popular stablecoins into their payment services. So Visa and MasterCard both allow transactions to be settled using USD coin, a stable coin. Or are stable coins more akin to the chimera, which is a monstrous, fire-breathing hybrid creature in Greek mythology? Stablecoin issuers look like banks when they take money and offer to return it on demand. But if they do not intermediate credit, would bank regulation be appropriate for them? Now, they may seem like money market funds, but are capital market rules sufficient to ensure that reserve backing is really there behind these stablecoins? We don't know. Stablecoins can potentially pose financial stability risks. For example, if there's a run on a significant issuer of a stablecoin, that could be contagion risks to financial markets should the reserve assets be rapidly liquidated. MAS has been thinking deeply about these issues, even as we license crypto token players and encourage experimentation in this space. We have to approach this chimera with flexible regulatory chains, which will allow us to harness its potential benefits, but can be tightened quickly if the beast threatens to breathe fire. The third phenomenon, central bank digital currencies. The history of privately issued money without public backing has not been inspiring. Will people put their faith in crypto tokens or stable coins that are not backed by central banks, which are dedicated to protecting its value? At the same time, is there not a way to harness the potential benefits of distributed ledgers through some form of digital currency? Hence, the global surge in interest in central bank digital currencies, or CBDCs. A CBDC is the direct liability of and payment instrument issued by the central bank. What is MAS's stance towards CBDCs? To answer that, let me distinguish between two types of CBDCs. One, you have wholesale CBDCs, which are restricted to use within the banking system and are akin to the reserves commercial banks place with the central bank today. Then you have retail CBDCs, which are issued by the central bank to the general public. They would be the digital equivalents of today's notes and coins. MAS sees much promise in wholesale CBDCs. They have the potential to radically transform cross-border payments. But since wholesale CBDCs, by definition, are not meant to be used as currency by the general public, they're not money. So let me focus now on retail CBDCs. Retail CBDCs are essentially digital versions of cash. Interest in retail CBDCs has risen sharply in the last 2 years. According to a survey by the Bank for International Settlements, 6 out of 10 central banks are experimenting with retail CBDCs. MAS has been carefully studying the economic merits and implications of a retail CBDC in the Singapore context. We have just released a detailed paper outlining our current thinking. There are 3 possible reasons for MAS to issue to the public a digital Singapore dollar. First, a digital Singapore dollar would make available the benefits of using central bank money in the growing world of online transactions. Like notes and coins, a digital Singapore dollar issued by MAS will be safe, widely accepted, and bear the authority of the state. Cash is the ultimate risk-free asset and means of final settlement. The rapid displacement of cash in favor of electronic payments based on bank deposits or e-wallets is one of the chief motivations for countries like Sweden and China to consider retail CBDCs. Second reason, a digital Singapore dollar could potentially foster an efficient and inclusive payment ecosystem. It could make it easier for smaller firms to build new payments and related digital services. Startups, for instance, can integrate with the retail CBDC and not need to build their own e-money and user base. This financial inclusion rationale has been a key motivation for countries like Cambodia and the Bahamas to adopt retail CBDCs. Third reason, a digital Singapore dollar could mitigate against the encroachment of privately issued stable coins or foreign CBDCs in Singapore's payments landscape. As these global digital currencies enter our market and become widely accessible in the future, they could potentially displace the use of the Singapore dollar in domestic retail transactions. A digital Singapore dollar that is issued by MAS that is congruent with the needs of a digitalized economy could go some way to mitigate this risk. But issuing a retail CBDC is not a straightforward decision. Retail CBDCs can potentially pose significant risks to monetary and financial stability. There could be some disintermediation of the banks, particularly during stress periods, if people can switch deposits into risk-free central bank money at the click of a button. Even in normal times, if people held a significant portion of their deposits in the form of digital Singapore dollars with MAS, it would considerably reduce our bank's ability to make loans. Now, we can likely manage these risks by designing the retail CBDC with sensible safeguards, such as stock and flow caps on the amount of digital Singapore dollars that anyone is allowed to place with MAS. On balance, the case for a retail CBDC in Singapore is not urgent. In fact, for a subject that is so controversial and has attracted so much attention, there are neither strong reasons for or against a retail CBDC in Singapore. Why do I say that? First, physical cash is likely to be with us for quite some time, and the need for a digital version of cash is moot at this point. The financial inclusion benefits of a digital CBCD, a digital Singapore dollar, are not compelling. A high proportion of Singaporeans have bank accounts, and electronic payments in Singapore are pervasive, highly efficient, and competitive. Now, the third reason, a possible currency substitution by foreign digital currencies, is for now a remote tail risk. The issuance of a retail CBDC is ultimately a socio-economic rather than a monetary consideration. Moving to a fully cashless society with all money in the form of bank deposits will not make a significant difference to the conduct of monetary policy. The question is whether the public is comfortable with holding only bank deposits and whether there is public demand for a state-issued currency that is as safe as cash, but in digital form. So for now, there's no strong case for a retail CBDC. But at the same time, MAS recognizes there could be potential benefits offered by innovative retail CBDC solutions in the future. MAS is therefore embarking on Project Orchid to build the technology infrastructure and technical competencies that are necessary to issue a digital Singapore dollar should Singapore decide to do so in the future. MAS will pursue Project Orchid in close partnership with the private sector, building on the rich findings from the Global CBDC Challenge that MAS launched earlier this year. We have received more than 300 proposals from over 50 countries in response to the problem statements that we posed. And this afternoon, the finalists of the Global CBDC Challenge will demonstrate their solutions to an international judging panel. Not to be outdone, Plutus, the god of finance, has not been idle. Finance is becoming increasingly digitalized, as we all know. New types of financial service providers, business models, and collaborations. I'll highlight just two developments that are shaping the future of finance. One, the quest for real-time cross-border payments. And two, the rise of collaborative data platforms. 5 years ago, MAS began experimenting with blockchain technology and wholesale CBDCs through Project Ubin to make cross-border payments cheaper, faster, and more efficient. The success of Project Ubin has inspired Partior, a blockchain-based interbank clearing and settlement network jointly established by DBS Bank, JP Morgan, and Temasek. It enables banks to settle cross-border payments in different currencies in real time, using either commercial bank digital money or wholesale CBDCs. Project Ubin has also served as a foundation for Project Dunbar. This is a blueprint for a multi-currency settlement platform that operates across countries using wholesale CBDCs. Project Dunbar is a partnership among MAS, the Bank for International Settlements Innovation Hub, the Reserve Bank of Australia, Bank Negara Malaysia, and the South African Reserve Bank. Commercial banks will be able to transact directly with one another using the wholesale CBDCs of their respective countries, eliminating the need for intermediaries and reducing the time and cost of cross-border transactions, if Project Dunbar succeeds. Not all cross-border payment improvements need CBDCs or the blockchain. Singapore's real-time retail payment system, PayNow, is building direct linkages with other countries' payment systems. PayNow has already linked with Thailand's PromptPay, enabling individuals in the two countries to transfer funds directly to one another's bank accounts using just the payee's mobile phone number. PayNow now plans to link up with Malaysia's Do It Now and India's Unified Payment Interface next year. But establishing bilateral payment linkages, one jurisdiction at a time, is hard work. We need a multilateral solution. MAS is therefore working with the BIS Innovation Hub on Project Nexus, which is a common blueprint for how countries can fully integrate their real-time payment systems onto a single cross-border network. If it works, it will make PayNow globally interoperable much faster.